Our next speaker is Nikola Krivacevic. He has experience in building and designing products as a software engineer, as a consultant, as a quant, and as a startup founder. He's passionate about finance, blockchain, machine learning, and tech in general. He's currently working as a software engineer at the crypto exchange BitStep, and he has 2 master's degrees, one in software engineering and one in computational finance. And today he'll talk about crypto derivatives, and the title of the presentation is Intro to Crypto Derivatives.
Thanks for introduction. Yeah, thanks for having and thanks for listening to this talk. As I was introduced, I work as a software engineer in the Bitstamp. Bitstamp is basically one. Okay, can you hear me now? Okay, great. So Bitstamp is one of the oldest crypto exchanges, and currently Bitstamp is undergoing efforts to launch a regulated derivatives trading platform. So today I'm gonna talk a bit more practical topic on crypto derivatives. So do I point here or? Okay, here goes. So these are some topics that we're gonna try to cover today. I mean, I know that derivatives are quite complex and we cannot cover everything in 20 minutes, but I'll try to set some common ground for people who have experience with this and who are new to this, so everyone can find something useful and meaningful from these 20 minutes or so. So if you guys can only maybe raise your hands if you ever traded crypto derivatives or at least know what our crypto derivatives are. Okay, I think I saw a couple of hands, so that is good. Hopefully that you will also learn something new. But yeah, let's just pop the question straight away. What are crypto derivatives, or what are actual derivatives? Well, strictly speaking, by definition, derivatives are financial contracts whose price actually depends on their underlying asset. Underlying asset can be anything, but since we're talking here about crypto, there are obviously cryptocurrencies, but it can be equity indices, equity bonds, and whatever. Today, we're gonna mostly focus talking about futures and perpetual futures, which are specific to crypto. And also, I would just point out that when you try to decide where you're gonna trade, for example, be aware if the exchanges are regulated or not. So in EU, we have MiFIR and MiFID and MiFID II regulations. So currently, there is none of the exchanges that are regulated for derivatives trading in EU. So why would someone actually want to trade derivatives? Well, there are some couple of things that are kind of useful for trading derivatives. First, so it allows you to speculate, basically to go into long or short positions. Also, that is very capital efficient way. So by trading derivatives, you trade on a margin and use leverage. So basically you provide only a small portion of the funds that would you otherwise do with the spot trading. Also, majority of the people kind of also use derivatives for hedging purposes to hedge your positions against price appreciation or price depreciation. And also compared to just regular spot crypto trading, it allows you to combine multiple kind of positions to create your proprietary strategies. So that can be, you know how it goes, either profitable or not. So on some topics about kind of some benefits and risk, we already mentioned a couple of benefits trading derivatives. I would only point out a couple of them additionally. So you, for example, when trading derivatives, you're not actually owning the assets. So you're just gaining an exposure to the cryptocurrency, so no need to worry about custody. So you don't need to transfer the funds to your personal wallet, or if you're trading probably on some exchange, there is probably some third-party custody solutions like BitGo and Copper and others, where actually they store your private keys. For example, a couple of weeks ago, I lost private keys from one of my wallets, but hopefully, sorry for that, but hopefully, yeah, there weren't too much assets on it. So that can happen, just be aware of that. Also, what is specific for perpetual futures is actually that do not expire. So that is one specific thing about that particular contract that we're gonna cover a bit more later. Also, what is good to know about derivatives trading is that those are highly liquid markets. So there is much more trading activity going there. So bid-ask spreads are going to be tighter. So basically, less chance to have a bigger slippage when trading there. But obviously, there are some risks. So when you trade on leverage, if it can work for you, it can also work against you. So it amplifies the gains, but also amplifies the losses. Also, when trading derivatives, you might have to be careful. We'll talk about what is margin a bit later, but you have to monitor your margin regularly because you can actually get liquidated and lose your funds. And also, if you opt for some bigger orders to trade via OTC desks, so there is also a chance for counterparty risk there, so for the other side defaulting on the contract. So in the next couple of slides, we're going to just briefly look at the crypto derivatives market to just get an idea of how big the space is and where actually you can trade derivatives. So when you want to trade derivatives, you can either opt to trading on centralized or decentralized exchanges. So when we're trading on decentralized exchanges, the only thing that we would need is basically internet connection and your wallet, and that's it. So you're trading on a smart contract infrastructure that is running on top of the blockchain. But when you trade on central exchanges, so those are kind of regular companies, brokerages, where that actually works. So I will just only point out, so sorry, I expected that it will be one, only one kind of display here, but I'm not sure if you can see. So I will point out that, for example, the biggest player in futures trading, crypto futures trading is CME, so Chicago Mercantile Exchange. That is the only regulated player in the space. And also, if you want to trade OTC, so there are a couple of bigger companies like Galaxy Digital and Genesis. If we now look at the volumes, it is really interesting to see that basically the derivatives volume is nearly 3 times as large as the spot volume. And if we try to basically narrow that search down and compare only spot or only derivatives volume and try to figure out centralized versus decentralized exchanges here, we can see that basically decentralized exchanges take about 15% of the market share in spot trading. But if you look at that for derivatives trading, it is only 2%. So there is a huge upside opportunity for derivatives decentralized exchanges to grow and even take some additional kind of market share from there. And for specific contracts in crypto derivatives, you can see that practically majority of trading activities is done via perpetual futures contracts. So I don't know how much, 96% of the volume goes in there. And the good thing to know and to notice about futures and options trading is that in both of those contracts, there is a significant market player in that space. For example, for futures trading, the Chicago Mercantile Exchange, which is regulated exchange, is the biggest player. And also for the options trading, so Deribit is majority of the market share it has. So, but Deribit is offshore unregulated exchange. So finally, we'll talk a bit more about futures now and perpetual futures to just figure out what they are and how they work. So futures are actually financial contracts. Well, one of the derivatives contracts, it is the simplest one. And what is specific about them is that they obligate the buyer to buy the asset or seller to sell the asset at a predetermined date in the future at a already set price. So again, you can use them either for speculating or for hedging. In, for example, commodities futures trading, you just please be aware, for example, for the contract details, it might load physical delivery of the assets, but here in crypto space, it is almost exclusively cash settled. And one of the examples, I don't know, for futures trading would be that the Bitcoin miner company would expect that in the next 6 months they would mine, I don't know, 20 Bitcoins, and they worry that the price of the Bitcoin might depreciate. So in order to hedge that risk, they can enter into a futures positions to short the futures contract in order to manage that risk. This is one of the exchange. It is called OKX. I just put a screenshot there just to get a feeling. So this is example for BTC USD pair. And you can see various expiry dates for the futures contracts. So this one expires tomorrow or the day after, so 24th of November. The next one on 1st December, 29th of December, and so on. And for the exchanges, most of the crypto exchanges actually offer monthly and quarterly contracts. And what you can see here on this screenshot, this is basically futures curve. So different futures prices with different maturities across a bunch of the exchanges. So the one thing to know, so if you look at from right to the left, so as we are approaching the maturity, we can see that futures prices are actually converging to the underlying spot value. And we'll talk a bit more why that is important in order to understand how perpetual futures kind of work. And also what it gives us an idea, what the market's perception, so what the market sentiment is about the future price movements for the underlying asset. As we saw previously, on the previous slide, we had an upward sloping curve, so the futures prices were trading at a premium, so that difference between the futures price and the underlying spot price is called basis. If basis is positive, so futures prices are trading at a premium, and reversely to that, if the futures prices are actually lower than the spot underlying value, we say that they're trading at a discount. I took one of the examples, so this is from Binance. If we look at the quarterly futures contract and the underlying spot, we can see how the basis was actually changing during the last year. And basically, there are periods when the basis was negative, so futures were trading at a discount. For example, a year ago, exactly at this period of time, the FTX collapsed, so probably there was a bit worrying market situation, so a lot of people were probably going short on Bitcoin. And in the recent few weeks, what happened is actually there were a lot of rumors that SEC would finally approve Bitcoin spot ETF. So the basis was positive, so market expectation was that the underlying price would actually appreciate. And now we're gonna talk a bit more about perpetual futures. So these are derivatives contracts which are specific to cryptocurrency industry. I mean, to be honest, the best way to understand the perpetual futures if you just basically draw a comparison to the regular futures. So the main and key difference compared to the regular futures is that these contracts never expire. So they have an infinite kind of lifetime. And how you imagine kind of perpetual futures contract is basically as the closest thing as trading spot without actually physically owning the asset. Plus, you add some additional things. So one of the things that you add on top of it is margin trading, plus ability to actually leverage up your position. And there is one specific thing for these contracts, and that is actually called funding mechanism. As we saw previously, so the basis can change dramatically. So what is specific about kind of futures contract is that they can actually deviate from the underlying price, but as approaching to maturity, the price would converge to the underlying. Based on the market sentiment, supply and demand for that particular contract, what it happened that the price of the futures contract, in this case perpetual futures, can deviate too much from the underlying, and we need some mechanism basically to keep it down and clip it constantly as nearly as possible to basically the underlying spot price. And that mechanism is called funding mechanism. Before you actually go into any of the exchanges and trade kind of futures, perpetual futures, my advice is basically just to inform yourself how exchange does certain things. So for example, index price is the price of the underlying asset. On most of the exchanges, they basically take just the average price of the spot across various exchanges. Mark price is the price that is actually used for calculating your P&L, for margin calculations, and also for liquidations. Some exchanges use the last price, which is not good because you know how volatile crypto is and there can be large swings. So that can actually trigger a ton of liquidations on derivatives positions. So most of the exchanges nowadays actually use index price plus some moving average of the basis, or they use mid price on the current exchange rate that is bounded by the index price. And also funding rate, that part of the funding mechanism that is small fee that needs to be paid. And we'll talk about funding rate a bit more. But here, for example, on the screenshot, you can see that funding rate is 1.5 basis points, and it is due in 2.5 hours. And we'll see what actually that funding rate is right now. So best thing to I don't know, to explain kind of perpetual futures is to think of them as a continuous rolling futures contract. So basically the sequence of a smaller futures contract from who everyone expires in 8 hours. And what happens after those 8 hours, the funding fee is paid. So who pays actually the funding fee and what is the funding fee? Well, the funding fee, you can think about it as the average basis. So it's the average difference between the perpetual futures price and the spot price during those 8 hours. That 8 hours is called funding period, and it is on most exchanges 8 hours, but again, you can inform yourself when you go to any of the exchanges. And if funding rate is positive, that means that on an average during that funding period, the basis was positive, so futures were trading at a premium. So price of the futures contract, perpetual futures contract was higher than the underlying. That's what needs to happen. We need to keep pushing down. And how we push it down? Well, basically that funding fee is paid from the long positions to the short positions in order to basically incentivize the market participants to go into short positions and bring the perpetual futures price down. So that is basically why this whole funding mechanism is invented. And this is one of the examples from Kraken, how funding rate was changing during last year. So we can see that basically funding rate follows and correlates to overall market trends. So when market is bullish, probably more people will be holding long positions. So basis on average would be positive, meaning funding rate would be positive. So longs would be paying shorts in order to push the price of the perpetual futures down. So that is how funding mechanism and what funding rate is. I created this maybe one visual example just to clear in your head what the difference between futures and perpetual futures is. So basically, let's imagine that today is 1st of December. We enter into a futures position and into a perpetual future position. So expiry date for the futures is 24th of March. So let's just imagine that we keep the position open until the expiry, and when the contract expires, basically it doesn't exist anymore, your position is closed, the P&L is calculated, you either lose some money or actually gain some money. In the meantime, what can happen basically is that, I don't know, maybe your margin falls below maintenance margin, you get liquidated, or you actually close the position early to cash in the profits or to cut the losses, and that's it. What happens basically in the perpetual futures when March 24 happens is that the perpetual future position is still open. So because it doesn't expire, so it doesn't have a maturity date. And you can think of it as a sequence of smaller futures contract which whoever has expiry date of 8 hours. And after that expiry of 8 hours, that funding fee mechanism happens to keep the price of the perpetual futures as close as possible to the underlying spot. So that is basically the main things about perpetual futures. And this is the last topic that we're going to cover today. So in order to trade derivatives, you must be informed and understand how margin works. So we previously at the beginning mentioned that derivatives are really capital efficient way of trading. That is because compared to spot, you do not need to provide the whole notional amount for the position, but you will be basically providing only a small portion of it. That portion that you put in order to open a position is called collateral. And the amount that is needed in order to open a position is called initial collateral. And obviously when you put collateral as a side to open the position, that collateral can actually appreciate or depreciate in a value. If it falls down below a certain threshold, which that threshold is called maintenance margin, you actually get liquidated. So those are two important things to know about margin trading for derivatives, that initial margin, initial collateral, and maintenance margin, what you have to have all the time. And this is one example for, let's say that you want to get into 1 Ether long position at 10x leverage. Let's say that ETH USD is currently trading at 2K. Instead of spot putting down the whole 2K dollars, you would only need to provide $200 to enter into 10x leverage position. So that is the power of margin that enables you. And also one thing to know about margin is basically then when you have that collateral that you put aside for opening a position, you can dedicate it to a single position. So whatever happens with that position, it only looks at the collateral you put for it. So that is called initial margin. You can actually put up collateral and share it amongst the positions. That is called cross margin. So how it works is basically profits from one position can actually cover the losses for the other position, or portfolio margin that is mostly for sophisticated traders and kind of bigger institutions that actually look at the whole your portfolio for managing a margin and calculating if you're above or below actual maintenance margin. So my advice, if you want to start trading with crypto derivatives, is definitely go first with initial margin. And this is the last slide that we're going to cover today. So this is one kind of numeric example of how margin works. Let's say that today is 1st of December, and we want to get exposure to 2 ethers long. And let's say that ether is again trading at a 2K. So in order to enter into that exposure via spot, you would actually have to provide $4,000. But if you have 100 times leverage on perpetual futures, you would actually need to provide only $40 to get into the same position, to get the same exposure, while your maintenance margin would be $28. And let's say after a couple of days, price of the underlying, so ETH/USD changes. Let's say that in the first case, it went up 1%. In the second case, it went down 40 basis points. And in the third case, it went down 1.5%. For the spot, you will be having the same P&L because basically you bought the asset. But for the perpetual futures, since you're actually trading 100 times leverage, you will be having 100 times more P&L. So for the first case, instead of 1%, you will be up 100%. In the second case, instead of 40 basis points, you will be actually down 40%. And in the third case, you will be actually down 150%. What happens for the second case, let's say that your actually collateral drops in value and you are now below the maintenance margin. That triggers liquidation, your position is automatically closed by the exchange, and some portion of the funds go to the exchange's insurance fund. In the third case, your actually collateral drops into negative values, which means that you actually lost more than you invested. But here in the crypto world, what happens is basically that you lose only your initial margin. Exchange actually jumps in and covers the rest of the losses from that insurance fund. So that is basically just a visual and numerical representation of how margin trading works. And also, if you're interested, I mean, just contact me later via slides. I will always send you slides because I put some additional kind of examples, also numerical examples for example, short hedging, long hedging, and basis trading, how it can be done. And I actually took the real numbers from one of the exchanges and calculated kind of possible outcomes. So thanks for being here and thanks for listening to the talk. If you have any questions, yeah.
Hi, me again. One question which caught my interest was the comparison between the trading volumes in regulated and unregulated exchanges. Like CME Group, I think, had the most volume in derivatives. Of course, spot is a completely different story here. And what I just know is, or could imagine, is that a professional money manager just is allowed to invest in some regulated products like derivatives on CME. But what you thought, or I don't know if that was a thought of you or an opinion, that maybe some other exchanges might rise as well against CME Group. So my first question is, how do you see that kind of development plays out? Will derivatives in crypto get bigger and bigger? And are there more exchanges coming or not? will those exchanges be regulated or not? And to be honest, the last remark, just interested what you think about it. It just undermines the whole story of crypto, in my opinion, because crypto, the idea of crypto was it's decentralized. You know, anybody can own it without governments involved. Now, what's coming up here, or what's already there, actually, it's a huge, one of the biggest exchanges in the world, which is heavily regulated by the government, but still which attracts lots of trading volume, which in the end, of course, goes into the crypto market. So what do you think of that and how this plays out?
Well, yeah, to be honest, for the CME, it is really kind of going to be too hard to compete with them. I mean, obviously for futures trading, but to be honest, I mean, after FTX collapsed last year, there has been a lot of market share open for derivative trading. So I personally know other people who are working at different crypto exchanges that actually those exchanges are also getting into derivative space. But for example, here where I work at Bitstamp, Bitstamp is taking a different approach, so they won't be offering kind of offshore derivative trading. So they're actually going directly with Slovenian regulators to acquire MiFID license to operate derivatives, so regulated exchange in EU. And what I know from actually clients, so bigger institutions, hedge funds, that actually they've been asking for derivatives for quite some time now, but not for perpetuals or futures. They're mostly interested in spot, because as we saw previously, I think like 80% of the volume in options, for the options. So 80% of the volume in options is on Deribit, which is offshore unregulated exchange. And most of the funds actually do not want to get into space until it's fully regulated. The good news is that soon in EU we're going to have MiFID regulation, and I mean, you probably all heard the news yesterday or this morning, I forgot, for the Binance and the settlement, and the SEC, CFTC in US kind of cracking down on every kind of crypto player. I mean, in my opinion, it is better to have a clear set of rules and to know what regulations are, and either you oblige by them or not. And if you're not, then you kind of suffer kind of some consequence for that. And on the topic of if it undermines the whole crypto point of decentralization, I mean, at least, I mean, there will always be going to be speculators, and at least here you won't be kind of having to own the asset, but just kind of to synthetically create exposure to it. I mean, same as the traditional finance with the whole derivatives market. So, I mean, the same question can apply for there as well. I mean, hope that it answered your questions, yeah? Cool. Sorry, you... Aha. Okay, cool. Any other more, or? Huh?
Taxation on that, so it's not appealing to trade that.
Well, to be honest, I'm not sure how actually would go for example, if you live in Slovenia, when you actually to list your kind of trades for the tax authorities or whatever. So to be honest, I'm not kind of introduced to that. I mean, to be honest, I only traded perpetuals for hedging and for leverage trades into lock positions, but I didn't deal with taxes, to be honest. So yeah. Yeah. Okay, I think that's it. So I think no more questions. Thanks for having me.
There we go. 30 minutes coffee break.